Hey guys, this is Hutch with bankingtruths.com, and today I'm going to answer a question that I get a lot, which is if I start overfunding a whole life policy to be my private banking engine, when can I actually start using it for purchases? Now, those of you that went through the original Banking Truths 3-part video course probably remember the pants portion in the second video, and since I'm in California, I'm going to draw them as shorts. Not very stylish ones, but in this pocket, nonetheless, it would be a whole life policy, and in this pocket would be your traditional banking mechanism, whether that's checking, savings, CDs, money market, whatever it is. And I find that my clients do have a decent amount saved up in reserves simply for liquidity, use, and control and safety. And unfortunately, for that trade-off, they're not going to get a lot of interest credited to their money. And what will happen if they do get any interest is they'll pay ordinary income tax on that income. And also, if they're supporting a family, usually they're paying something in the way of term insurance that doesn't build any equity or have any growth at all. Now, simply by taking some of this liquidity and safety money and putting it into another vehicle, which is historically very safe and can be structured to be very liquid, and you have to do it for at least 5 years. But if you just move some of this money from one pocket to another pocket, what you're going to do is you're going to create a very nice compounding engine, a very nice banking mechanism. And over time, you'll probably find that you do get a much better rate of return. There won't be any tax due on the growth or the distributions if you keep the policy in force, and you'll need less or no term insurance depending on how big of a banking policy you set up. Now, what we're going to do is we're going to take this hypothetical model and we're going to look at an actual whole life illustration that's structured to do just that. This is an actual illustration for a 45-year-old using the 2015 dividend scales, and they are not guaranteed, although this company has paid them for well over 100 years, as of all the companies that we recommend. And although dividends will change, keep in mind that dividends, which are largely tied to interest rates, are historically very low, and there's a good chance that they can go up in the future. Now, with that out of the way, let's go ahead and take a look at this illustration in the context of the pants. And there's really only two columns here that we're going to focus on, and that would be the total net outlay, which is your premium, and the total year-end cash value. And if we see that this 45-year-old gentleman wants to put in $35,000, by the way, don't get attached to the dollar amount. Let's just focus on the percentage. If he puts that over here, and by the end of the year, in today's low interest rate environment, he has $27,000 over that. That's actually over 78% of his cash value is available by the end of year one. Now, one of the things I bring up is when clients do have significant money in savings, and I ask them, when's the last time you tapped 75% of your savings account? The answer is usually never. You know, they usually keep something in reserves. So with that in mind, let's just go ahead and take a look at how much of a percentage we have each and every year. So if we look at year two, where the $70,000 have gone in, and there's access to over $56,000, that's actually over 81% of your cash value. By year five, notice this, that $175,000 has gone in, and really there's almost $175,000 sitting right there in cash value. So I think that's really important to notice that you will have sufficient amount of liquidity out of the gate, not total, but when I ask clients what they're doing with their current savings account, they rarely need total liquidity anyway. And let's not forget that by agreeing to not have total liquidity to these funds in the early years, you're going to get two things for your money in return. For one is you're going to have a substantially better mechanism to grow your money going forward, which we're going to look at in just one moment. But let's not forget this part. I don't know any other savings account that if you were to die and have anywhere from $35,000 to $175,000, they'd pay your family 1.2 to 1.4 tax-free if you were to pass away. So I want to look at this together. Let's take a look at where, after our break even, and let's just round up and say that this is our break even point, the 174, 174 plus the 35,000 of premium. Let's see what kind of output we get or what kind of rate of return we get on those inputs. So let's do this together. 174,811 plus $35,000 of premium. Now it's $209,811. Now notice we have $219,000. So if I multiply the $209,811 that we have in there times 1.044, basically saying that we're going to get 4.4%. Notice how this figure here, 219,042, is smaller than this figure here, the 219,062. So I don't know any banking mechanism in this environment right now that's going to give you 4.4%. Not to mention a banking mechanism that's going to say, you know, I have a special deal with the government because we take care of widows and orphans where you don't get taxed on the growth of your money. Now let's just take it down to, let's go all the way down to the last column down here because it gets better and better every year. So let's take a look down here because this policy gets better and better every year. And so if we take this 743,549 plus our $35,000 of premium, which by the way, you don't need to pay at this point. You could stop paying premiums. But if you have a mechanism that does this, why would you want to stop? So it's saying we should have 778,549, but you can see here that we have 819. So if we take this and multiply it by 1.052, basically simulating that we're going to get 5.2%. Notice how this figure is still smaller than this. So a friend of mine explained this to me really well, and the reason why the policy gets more efficient is it's like a jet airplane that takes off from, say, Los Angeles to New York, and it's just full of fuel, so it's not going to be as efficient as later on when it gets from, say, Pennsylvania to New York, because what happens is a lot of the fuel is burned off, so the plane's gotten more efficient. And the same thing is happening inside this policy where more of the mortality charges are burning off and you're getting mostly growth. Okay, so let's go ahead and bring it back full circle to when can I start using the money in my policy? Well, just like you could take the money out of this pocket at any time, so can you also utilize the funds in your cash surrender column. And even though there is somewhat restricted access early on, it's fairly nominal compared to what you're probably going to need if you are indeed starting one of these policies. And you can withdraw everything you see here in this column at any time for any reason. However, you're going to see in future videos that there are advantages to utilizing the loan feature and to borrowing against this fund and to keep it compounding. And the simple reason is if you have a mechanism that compounds steadily and safely at a very nice clip without any taxation going on, if you borrow against that and then you go ahead and pay back the loan, well, you don't lose your place in line on this curve, and you can keep using it again and again rather than killing the goose that will continue to lay golden eggs.